This is to let people know it's being recorded.
Hello, we're 3 minutes before 6, so we will try to start as quickly as possible after 6. We have about 25% of the expected people, and I guess, what would you say, on the webinar right now, so we're gonna just wait a little bit longer. Appreciate you taking the time out this evening to spend an hour with us. All right, well, it's 6:01 in the wonderful world of online Zoom meetings. The protocol is to always try to start on time. About 2/3 of the people who have signed up have joined. I'm sure that the rest of them will be joining soon. I will let everyone know that we are recording this meeting. We're recording it for two reasons. One is because we go back and listen to our own webinars to see how we can do it better. And actually, quite frankly, with input from you, how we can make these meetings better. And also, if somebody missed the meeting, it's a great opportunity to be able to send it out to them after the fact. And if anything, after the market actions today and what's going on in the market, this is quite a timely time to be having a portfolio management roundtable. Just if we could go on to the next slide, I want to share the individuals that will be speaking today. If you don't know, my name's Clark Kendall. But speaking first will be our Chief Investment Officer, Brian Maddox. He's been with the firm with Kendall Capital for over 7 years. He has done a great job of strategizing the 6 investment strategies we have. Him and our Jason Tkach, portfolio manager, he's actually been with the firm for over 10 years. And Zeman Zhu also is a portfolio manager. He's been, I have to get these years, but he's been, what, 8.5 years been with the firm. And Justin Wonder just is a graduate 2023 from Daniel College. He's actually already passed the first test of this the CFA exam. But it's they are really what I call the infrastructure, the brains behind making the investment management work so well at Kendall Capital. They each have unique skills and talents, and when we combine them together, I think they're the individuals that have made the investment performance so strong for Kendall Capital. And I'm proud to work alongside of them to basically help serve you, the clients. The next slide will be quite frankly the agenda for what we want to talk about. We're going to talk about the health of the economy, what's going on. We're going to talk about the concerns in the financial markets that we have with what's going on in the marketplace. I always consider them kind of the landmines, and I think our job as wealth managers is to make sure clients, to the best of our ability, stay away from the financial landmines. And we've seen them time and time as history does repeat itself. But with any landmines, there's also opportunities in the market. And where we see the opportunities, where we're steering the investments that we manage. As you all know, we employ 6 different investment strategies. And we are making changes within each one of those strategies. And so we're going to outline those changes within the strategies and how we're implementing what we think are the benefits for our investors. And then we always like to address behavioral biases. I think what's going on from a political standpoint, there are heavy investor biases, and quite frankly, we can't change what the politicians are doing, but we can manage through what they're doing and how they affect not only the markets, but also how they affect us as individual investors. So with that in mind, the next speaker will be Brian Maddox, and I'm going to let him talk about what's going on with the economy at this time.
Very good. Thank you, Clark. And thanks everyone again for joining us this evening. It's always a good time for us to get around and kind of talk about what we like to talk about. So this is always fun for us. So let's jump in. Let's look at the overall health of the economy, illustrated in the next, I guess, 4 or so slides. I'll go over and kind of give you a picture of what's going on. The first one here is the U.S. GDP, or gross domestic product. This measures the total value of all goods and services produced within the U.S. And specifically, we're going to be looking at the GDP growth and how it's growing to get a good measure of what's going on. It's a really good measure to see how fast the overall economy is growing or contracting after taking inflation into consideration. As we can see here, GDP remains in about the 2 to 3% range. That's consistent with long-term averages. 2024 was another impressive year for the overall economy. Resilient consumer spending supporting basically a 4th consecutive year of above trend growth, which was pretty impressive coming out of COVID. Looking forward to 2025, policy uncertainty is casting a haze on the overall economic, kind of outlook. So we're trying to, get as much clarity as we can, but again, there's a lot of fog and haze out there right now. But fortunately, none of the proposed policies so far from President Trump is really posing all that much trouble for the economy so far. And I really, can emphasize so far, but we'll see how it all plays out. But at least in the short run, what we're seeing is the economy, still growing, at a decent clip. Like I said, basically towards long-term averages. 2025 should be another year of modest expansion, driven really by healthy earnings. Like we saw today, we saw some companies come out with earnings. A lot of Wall Street didn't like a lot of it, but if you look at the underlying earnings, they're fundamentally pretty sound. So that should support, economic growth going forward. So we're likely this year looking at a trend-like pace, for the overall economy. And then next up, we'll look at unemployment, another, pretty big and important factor for the economy. What we see here is that we've ticked up since the middle of 2023, but we're still nowhere near where we are, during COVID and post-COVID. Long-term averages, they hovered right around 3 to 4%. Until recently, 5% was typically considered full employment. So after rising during the first half of 2024, we're currently right in that range. It's really a good signal that most who want to work are working. So that overall unemployment, rate has basically stabilized, here through 2024 and so far in 2025. So stable unemployment means wage growth should also stabilize. All this along with solid productivity gains through AI and new technology, in theory should help keep, inflation down and maybe put some downward pressure on inflation. And I'll talk more about inflation here in a second. But obviously the big and, the really huge unknown will show up on the April jobs report. This will show the effect of the recent government resignations and layoffs. It's estimated to be total of about 100,000 jobs in this first wave. That consists of about 75,000 that agreed to the deferred buyouts, and they will be paid through September, in theory. And about 25,000 were just straight laid off. So, the 100,000 total, I guess the silver lining in that is the private sector is expected to absorb a lot of these jobs, and those that want to go back to work, can be, that'll be a good bulk of that 25,000. The bigger concern, however, is future layoffs and where this is going. That could shrink the currently 3 million, government workers, or about 1.9% of the total U.S. payrolls, by as much as about 400,000, government jobs over the next few years. And added onto that, and another unknown and definitely a concern, is how this affects the government contractors. So for every one government worker, there are 2 contractors behind that government worker. So with contractors included, this could increase layoffs to as many as 1 million people. So increased unemployment will most likely affect interest rates. It will obviously affect the overall economy, including stock and bond markets. So it's really something that we're really keeping a close eye on, as it plays out. And then lastly, another wild card is immigration. So that adds even more fog to this kind of unclear outlook. Will a tougher stance on illegal immigration help or hurt the economy? We really don't know how all that plays out. So again, we're keeping a close eye on all these factors. All right. Next, we'll take a look at another current hot topic, and that's tariffs. So geopolitical tensions and supply chain restrictions induced by COVID-19 prompted a global reevaluation of open trade policies. I think we kind of all remember about that, how that all played out. And tariffs sit at the center of the Trump administration's agenda. So beyond, discouraging imports, tariffs can have a further negative unintended consequences. And if implemented, aggressive tariffs could lead to retaliation and, quite frankly, higher inflation, adding even more uncertainty to an already, foggy kind of outlook. So on this slide, as it illustrates, you can see what, another kind of silver lining here is the U.S. relies less on trade relative to other developed countries. And then we measure this by percentage of GDP. So relative to other countries, and we can see that the U.S., about 20% of the U.S. GDP comes from international trade. But like countries from, the countries like Germany, and some of the others, United Kingdom, as much as 80% of its GDP is based on trade. So the U.S. has remained fairly consistent with how much it relies on trade relative to our GDP growth over the long term. So it kind of acts as an insulating kind of factor for all these tariffs. Again, how much so, we don't really know. So we'll see how all this plays out. Are these tariffs a bluff? Will they be implemented partially, fully? We just have no way of knowing right now, even with this being, part 2 of this administration. So also this relates to currency. So, and really specifically to the dollar strength, which typically allows more imports, foreign goods are cheaper. which kind of offsets the tariffs as well. So, we'll see. There's a whole bunch of different, forces at play here. Obviously we're keeping a close eye on them. Which brings us to the next slide, which shows interest rates and the yield curve. So you may recall over the past 4 years, the yield curve which represents what bonds are paying in interest, has been inverted, which means you're getting paid a higher rate to take less risk at the short end of the curve, relative to the long end. In the long term, this just isn't sustainable. Taking more risk on the long end means you should be paid a higher rate, to compensate you for that additional risk taking. We can see on this slide that the yield curve has returned to a more normal shape as the Federal Reserve has eased policy and cut rates. And overall, this signals a healthier overall economy. It's kind of a ray of sunshine or clarity in this kind of foggy outlook. And if you remember a few years ago, there's a few banks that failed, and this was primarily due to that inverted yield curve. This was due to longer rates were relatively low. So to match their liabilities, they had to go further out on the curve and take more interest rate risk, for higher yields. And then when interest rates shot up, obviously the bond values, went down. The rest is history. Those banks, and their balance sheets basically became insolvent. So the curve is, still relatively flat. It's a normal shape, but it's still relatively flat. So short dated bonds we see here are paying about 4.3%. Longer term bonds are paying about 4.8%. So that, only half percentage point difference, it's still, a really good positive that's inverted, but it's still relatively flat. So how this plays out with portfolios, as long as this condition exists, where we're being paid, a good healthy yield on the short end of the curve, we'll try and exploit that. So we'll take that free lunch, while we can get it. So we'll hold, safe money markets, short-term bonds, as long as we're getting paid, as much as we are for if we had to go way out on the curve, we're gonna take that, all day long. All right, and while we're on the topic of rates, this is the dot plot chart, and it gives us an idea where the Federal Open Market Committee, or the group of Federal Reserve officials who set the U.S. federal fund rate, foresee the federal funds rate going over the short term and long term. These views, basically are primarily based on inflation. So they're keeping obviously a good close look at inflation and the pulse of what's going on there. What's really interesting, and I always find this interesting about this plot, is the wide dispersion of its members, especially if you look out towards the long term. These guys have the same information, they're looking at the same stuff, but yet they still, are not in agreement to where they think rates are going to go. Overall, we're seeing that they're basically predicting 2 more quarter point cuts. We kind of think that's a bit optimistic, and many economists feel the same way. So, in 2024, inflation was trending lower, and with the labor market softening, the Federal Reserve aggressively cut rates by about 100 basis points. In 2025, looking forward, the committee will have preference to continue this easy policy, but it's with the resilient economic growth and pending inflationary policies, it could make lowering rates very difficult, and a more gradual policy easing path is probably more likely, limiting really any larger downside move in rates, which, quite frankly, the equity markets don't like all that much. They want to see lower rates. That said, until we get more clarity on Trump's policy agenda, the pace of rate cuts will continue to hinge really on incoming economic data, as Fed Chairman Powell has stated over and over again. So, as we stand now, the Fed is kind of in a bit of a pickle. The economy is growing positively, albeit not really robustly. Inflation is sticky, perhaps trending upward, which hinders the Fed, lowering rates. But if unemployment does tick up, and we'll see how this all plays out with the government layoffs and contractors, we could see more pressure for further rate cuts. So we'll see how this all plays out. Overall, these factors, are going to make it difficult for the Fed to continue an aggressive rate cut regime. And with the benefit of hindsight, the Fed basically kept rates too low for too long. So Powell is going to be very, kind of conservative and sluggish about approving more rate cuts. And again, he's reiterated time and time again, any further action will be data driven. So if we were having this conversation, at the beginning of the year, the market was pricing in an additional 25 basis point cut in March. That probably now has fallen to basically zero, and any future rate cuts are not expected until June or July. But again, inflation appears to be sticky, with the economy showing signs of strength. And then further on inflation, remember massive fiscal stimulus plans that were passed and supply chain problems drove inflation up to 9%. So we've come down significantly since then. But importantly, a decline in inflation is not the same as deflation. In other words, when we're currently sitting at about a 3% inflation rate, that means that prices are still increasing by 3% each year. Obviously far less than 9%, but prices are still going up. And even if the Fed, is successful at getting down to its 2% target rate, that's still a 2%, year-over-year increase in prices. Obviously, not 9%, but that 9% is already baked in. So, that's why, Americans are not really feeling like prices are coming down, because they aren't. They're still increasing, but, at a much, much, slower pace. Well, the outlook remains unclear. Over the next few years, government policy, interest rates, and AI will pave the path for U.S. equity markets, for better or worse. Given this, investors should maintain a long-term view, stay diversified, but nevertheless, we stress, current earnings growth highlight the fundamental strength of U.S. companies, which should support, markets as we move forward throughout this year. So with that segue, I'm going to turn it over to Jason and Zeman. They'll talk about areas of the market we're concerned about, but also where we're seeing some opportunities and how this all plays out for your portfolio. Jason?
Yeah, thank you, Brian, and good evening, everyone. Said it before, but thank you all for joining us. We really do appreciate you taking the time to spend it with us. So with Brian having discussed the economy, we want to discuss some of the investment themes in the equity markets and how they relate to what we're doing with our Kendall Capital strategies. For me in particular, in relation to our equity strategies, the GARP and the income and growth portfolios. First up, this chart shows U.S. stock market concentration over the past 30 plus years. What this chart makes clear is that relative to recent history, the U.S. stock market, in particular here, the S&P 500, it's relatively concentrated in a handful of names. So going back to the dot-com bubble, the top 10 names in the S&P represented less than 30% of the index. But today, as of 2024, the top 10 represent over a third, around 36% of the index. Now, I should make clear that these are not all-time highs in terms of stock market concentration. Going back to the 60s, we had a higher concentration. But we do think that many of the names today are priced to perfection, meaning that they have little room for error based on what the market is pricing in terms of growth expectations for these firms. So a case in point may be NVIDIA today. If you were watching CNBC or looking at the news, it reported earnings yesterday that beat expectations, but perhaps by not enough, as the stock traded down today despite that beat. So also I should note is that we do hold a handful of these names in our portfolios, notably Broadcom, as you can see, and Alphabet, albeit we've often bought them at much lower stock prices than they're trading at today. So the next chart further illustrates this theme. It shows that the top 50 names of the S&P 500 represent around 60% of the index's total market capitalization. This means that the top 50 stocks are worth more than the remaining 450 stocks combined. They're also more expensive, as the price to earnings ratio on the left vertical axis shows. I'll explain the price to earnings ratio in a few minutes, but I just want to point this out, as the blue bars on this chart shows price to earning ratios by segments of the S&P 500, while the right vertical axis and the orange dots show the segments show the segments weights within the index. So in light of this market concentration, which is again high even by comparison with the dot-com bubble, within our GARP and our income and growth portfolios, we're continuing to focus on valuation, and we do see more value in smaller cap and less expensive names. The next chart shows 10-year returns for major indices, both domestic and international, over the most recent 10-year period. Just to review briefly, the S&P 500 and the NASDAQ indices are U.S. focused stock indices, with the S&P 500 generally the 500 largest stocks, and the NASDAQ a tech-heavy index with names like Microsoft and NVIDIA, with which you may be familiar. The Russell 2000, by contrast, is small cap names within the U.S. market, and the MSCI EAFE, which is a bit of a mouthful, that's an international index of developed markets excluding the U.S. So it's an international developed ex-U.S. index. As you can see here, the NASDAQ and the S&P 500 over this past decade have far outstripped the international developed and US small cap markets over this decade period. However, if we look at the decade of 2000 to 2010 on the next slide, the picture is quite different. The Russell 2000 small cap stocks were up over 25%, close to 28% for the decade, while the international developed markets and the S&P 500 were down around 25%, with the tech-heavy NASDAQ down over 40%, over 43%, in fact. And as you may be aware, just simple math, if you lose 50%, that means you'd have to have 100% gain just to get back to your break-even point. So these two charts showing 2 decades in relatively close proximity to each other illustrates how different segments of the US stock market, as well as the international markets, have under or outperformed across different time periods and market regimes. In our view, this also illustrates the importance of asset allocation and essentially not putting all your eggs in one basket. This ties in nicely to the next slide, which shows that on a relative valuation basis, we believe that our own portfolios, here in particular the GARP portfolio, compare favorably to various indices. So comparing some of the indices shown at the top of the table, we can see that the GARP portfolio has attractive operating margins and return on equity, particularly when we take into account the valuation of the portfolio and the indices. So if we look at the bottom of that table, the valuation table, we can see that the GARP portfolio is trading at roughly 16 to 17 times trailing 12 months earnings, compared to close to 31 times for that of the S&P and over 40 times for that of the NASDAQ Top 100, with the Russell 2000 closer to around 20 times earnings. Now, as I promised I'd explain, the price to earnings ratio is essentially the price you pay for a stock per dollar of its earnings. So if a stock's price to earnings ratio is 16 times or 16 to 1, that means that you're paying $16 for every $1 of per share earnings. The PE ratio, the price to earnings ratio, it's essentially a way to compare stocks more directly. So generally, if you have 2 items of similar quality, you'll prefer to buy the cheaper one. An analogy might be if you go to the supermarket and you walk down the aisles, if you see 2 cans of, or see 2 different brands of chicken soup, for instance, and you like both of them, but one of them is half off, most of you will probably grab the cheaper can of soup. This isn't a perfect comparison, but it may help illustrate the comparison that all things else equal, the cheaper price to earnings ratio can be more attractive. The inverse of that price to earnings ratio is the earnings yield, as you can see in the graph, which shows the earnings as a percentage of price giving you a yield. The GARP is close to a 6% earnings yield versus roughly 3% and 2.5% respectively for the S&P 500 and the NASDAQ Top 100. Along these lines, we can see that with the price to sales ratio, this time comparing revenue or sales instead of earnings, the GARP portfolio is trading at 3.4 times revenue versus over 7 and close to 10 times for the S&P and the NASDAQ Top 100, with even the Russell 2000 here more expensive at over 6 times. Also, we are seeing more value in smaller cap names, as mentioned. So the GARP portfolio, while by no means a small cap portfolio, as you can see when compared with the Russell 2000 on the right, as it does include also some of those larger cap names that I mentioned, like Broadcom and Alphabet, it has an average market cap still significantly lower than the S&P and the NASDAQ Top 100, which are over $1 trillion for the S&P and closer to $2 trillion for the NASDAQ Top 100. So a lot of those numbers aside, finally tying in the next slide into the theme of tariffs and international markets versus the US market, which my colleague Zeman will go into more detail in just a minute. This chart shows that the share of revenue generated from foreign sources is quite different when you look at the Russell 1000, which is the largest 1,000 US stocks, versus the remaining 2,000 small cap stocks of the Russell 2000. So as you can see here, close to 40% of the large cap Russell 1000's revenue is derived from foreign sources, while for the Russell 2000, roughly half as much of their revenue, or less than 20%, comes from outside the US. So while there is much uncertainty with tariffs and their potential impact on both the economy and the stock market, this is some food for thought showing that more domestically focused US small cap names may be relatively more insulated from the impact of those tariffs. With the key emphasis on May, there is a lot of uncertainty, to be fair. So we've now discussed current stock market concentration relative to history as well, compared recent and past performance of several major indices, and analyzed the relative valuation of the CARD portfolio and some US stock indices. Hopefully this has helped put into perspective some of the recent trends in the stock market. And with that said, I'll turn it over to Zeman, who will talk more about the markets, this time with more of a focus on our mutual fund and ETF strategies.
Great. Thank you, Jason. Good evening, everybody. This is Zeman Zhu. I'm one of the portfolio managers at Kendall Capital. So thank you for joining us this evening. So I will start with, referring back to Brian's and Jason's comments regarding the market cap concentrations, where small and mid-sized companies are underrepresented in many of the well-known indices, such as Russell 3000. I would like to use this slide to further illustrate the point. So if you draw your attention to the last row of this table, you will find that small cap companies in Russell 2000 index counts for approximately 2/3 of the constituents in the Russell 3000 index. However, if you look at the market cap of those companies, they are assigned in aggregate only 8 to 10% of weight in the index, meaning they're underrepresented. So where there is a underrepresentation, we will find opportunities there. That is the reason that why we can design our mutual fund and ETF strategies to strategically overweight small and mid-sized companies, while still providing clients with a broad equity market exposure. So we will invest in both all large cap, mid cap, and small cap companies, but with a emphasis, overweight, if you may, in the mid-sized and small-sized companies. And additionally, different from the two individual equity strategies Jason was just discussed, where a bottom-up approach is applied to those equity strategies, focus more on the individual stocks characteristics like PE ratios. These fund strategies will create it from a top-down perspective to utilize the broader market opportunities and serve as an excellent complementary to our individual stock strategies. And also on the next slide, Brian and Jason, they also mentioned previously that the top stocks within S&P 500, especially the ones known as Mag 7, like Meta, Microsoft, and NVIDIA, just reported earnings yesterday, and stock price are getting killed today. They have much higher valuations than their peers. And this slide, this chart, kind of established a kind of interesting historical relationship between the relative valuations and returns of the small cap companies compared to their large peers. So as you can see, the horizontal axis kind of represents how cheap and expensive small caps are compared to their peers. So ranging from the cheapest from the left to the most expensive on the right. And the vertical axis represents how much outperformance or underperformance small cap companies generate compared to their peers. So again, ranging from the best outperformance at the top to the worst underperformance at the bottom. And the dots highlighted in blue, primarily on the left side of the chart, illustrate historically when small cap companies becomes as cheap as they are now compared to their large peers, they're likely to show outperformance over their large peers in the near future. But it's not a market prediction. Again, it's a high probability event that would likely to happen, but not a market prediction. It ties back to where Jason and Brian was describing that if there is a valuation gap within the stock market, we tend to find opportunities within those cheaper value stocks. Following the very simple principle of buying low and selling high, we will systematically rebalancing our fund portfolios back to desired target. In this case, fund of funds will focus more on the small mid-sized cap, will by selling the large cap holdings and move the proceeds to underweighted portion like a small and mid-sized cap within our fund of fund strategies. We also technically introduce moderate overweight, underweight decisions to the rebalancing models based on the relative valuations of those asset classes. And on the next slide, I think the story can be continued to the international equity market, where the valuation gap between the US and international equities has reached the widest historical level. And the US stocks have appeared the most expensive than their international peers across its chart history, as you can see on the screen. By a quick glance, you will find that there's a big vertical distance between the red line and blue line at the right end of the chart, where the red line representing US stocks valuations and the blue line representing international stock valuations. If you move to the next slide, we can see that not only US stocks have become much more expensive than their international peers, the US market exceptionalism and outperformance has also reached its 14 years record The chart shows the 2023, but the outperformance of U.S. stock market extended into 2024. That counts for 14 years mark. That's the longest U.S. outperformance history since 1975. But starting off this year, 2025, we started to observe international markets outperforming U.S. equities year-to-date performance. So if you do a quick number check, you will find that year-to-date performance of stocks in developed foreign markets have returned as of this market end of today, has returned around 8%. Well, S&P 500 jumps between positive and negative territory, hovering there. And NASDAQ Composite, shockingly, returned a negative 4%. So again, following the logic of valuation awareness and simply buying low and selling high, we also updated our international strategy from international 60-40 to international diversified by swapping from alternative asset classes to international asset classes, international equities specifically, where we see a lot of the valuation opportunities there. The transition starting from third quarter of last year. And if we move to the next slide, the same story can also be told within the micro cap space, which also we're very excited about opportunities presented in the domestic micro cap stocks, where the valuation is cheaper and stocks are underrepresented. Excuse me. So finally, just to drive my point home, we always incorporate valuation considerations into our portfolio management practices. Although the valuation focus may not yield positive results in the short run, like we see in 2024, where tech stocks really take the lead and the high valuation stocks really generates tremendous performance. But we still believe that by focusing on valuation, it can help protect our clients' wealth from extreme negative market events in the long run. And also, additionally, I just want to emphasize that we also always keep on learning and evolving, and we're doing our very best to validate and integrate any industry news, trends, ideas into our portfolio management practices. And with that being said, I will turn it to Justin. He will discuss how we incorporate behavioral finance and science into our portfolio management practices. Thank you, everybody.
Great. Thank you, Zemin. So I'm going to dive into the world of behavioral finance and how it can potentially affect investor and market returns. So behavior biases in finance are basically those mental shortcuts and the emotional reactions that cause people to make irrational decisions with their money. This slide here shows the traditional finance assumptions versus the actual reality of what happens when investing. Traditional finance theory assumes that all investors are rational and therefore don't have any emotions or have any biases towards their money, leading to markets being completely efficient, which in reality, we don't see in the real market. Instead, behavioral finance says that investors are humans who make mistakes, they have emotions, and could make poor decisions with their money, leading to investor returns not equaling investment returns, as you see here on the slide. Based on research done, this can actually lead to a difference of potentially 6.1% annualized returns that investors can miss out on, which is known as the behavioral gap due to these biases. Moving along, let's take a look at some of the biases. These biases shown don't just affect people at the individual level, they can actually drive markets as well, sometimes making downturns even worse than they already are. But on the flip side, they can also create some strong opportunities as well. We all have these biases, and they generally fall into these two main categories, emotional and cognitive. Starting with emotional, they are, as the name suggests, based off our emotions. They're usually extremely hard, if not impossible, to completely change and correct, and thus need to be considered by the portfolio managers during the portfolio design process. Cognitive biases, on the other hand, come from flawed thinking, and because of that, can often be corrected through more education, experience, and processes being put into place. So now let's take loss aversion, for example, an emotional bias. This is when people generally feel more pain from losing money than the joy of making that same equal amount of money. This often leads investors to holding on to underperforming investments, hoping and wishing they'll bounce back, while missing out on some better investment opportunities that money could have been used for. On the cognitive side, one bias that almost everyone is guilty of having is hindsight bias, also known as the "oh, I knew it all along" bias. It's when you look back at a stock that you bought a while ago and it has since dropped in value, and you try and convince yourself, "oh, I should have seen that coming." even though when you bought it, you had no idea what was going to happen. These biases are extremely hard to overcome, which is why they show having a financial advisor can be so valuable. It is someone to take emotions completely out of the equation and keep you disciplined to your financial plan. This slide shows the results from a white paper that was put together by Russell Investments. And it shows here and quantifies that a good advisor can add about 5% of value to keep your portfolio on track and in line with your various goals, circumstances, etc. And as you can see, the behavioral coaching aspect plays a big part of this value, potentially adding over 2.5% of added value. Advisors can be especially valuable during uncertain times and, helping to talk you off the cliff, so to speak, and to prevent any emotional decision making that may hurt your financial goals, like wanting to completely liquidate your entire portfolio to cash because you may have uncertainty about the current market conditions. All right, with that being said, I'll turn it back to Clark for some closing remarks and any questions you guys may have.
Well, first of all, first thing I want to do is kind of review what we went over. I think Brian so eloquently put that we do have a healthy economy when we look in the rearview mirror. GDP is growing, corporate earnings are growing, unemployment's low. Inflation has been brought down, not as much as the Federal Reserve, not as much as the Federal Reserve wants. I think Jerome Powell within the last week has commented that they're not going to make any dramatic moves with the Federal Reserve and interest rates until, quite frankly, they see how the political actions of the administration play out, laying off all these federal employees, putting tariffs in place, trying to bring the war together with Ukraine. He basically wants to see how effective it is. And I think that, that's valid concerns. Brian also pointed out that we actually, even though the Federal Reserve cut interest rates twice in the fall, brought short-term rates down, it actually slightly increased, intermediate term and long-term rates. So the yield curve has moved to a normal yield curve, as he pointed out. That's technically a sign of a healthy economy. And actually, since the elections in November, that really has not changed. If anything, it's become more positive. As we mentioned, I think the biggest concern we have is actually what as I refer to as the landmines, and we are concerned about the landmines, and we do consider the equity markets, those top 10 holdings. We have participated with the rally in the markets, but we're actually going through as far as client by client basis, managing portfolios when we can, use the securities that have done so well. And Broadcom is a great example. I call it NVIDIA's little sister. It's almost as up as much as NVIDIA, using that for donor advised funds, charitable contributions, using it to rebalance the portfolio. We also are using it, quite frankly, to make sure we have cash on hand. We're utilizing either the inflation protection, money markets, or CDs to make sure that we can meet the client's income needs, over the next 3 to 4 years. I know Dave and Carol have been speaking to many of you to making sure that those things are all in place. On the opposite side of the coin, what we've pointed out is basically on the equity market side, there is a big segment of the market, a very strong companies that trade, not the top 50 stocks of the S&P, but there's other 450 of the S&P, the Russell indices, the broader market. They're trading at very fair valuations. These underlying companies, have strong revenue and earnings growth, and they're trading in valuations, as Jason pointed out, at around half of where the broad market is. And we really do think that's great opportunity. It's quite frankly been the kind of the hallmark of us managing money in the past. Zeman also pointed out, the international markets, the valuation is historically low. The international markets, we're going on historically long time where the international markets have dramatically underperformed the domestic markets. We do believe in mean reversion. And as many of you have heard me to say, if you've ever been to Italy or Greece or Spain, the wines there are very good, and they're about, a fifth the price of trying to buy Virginia wines or California wines. So don't just buy the wine, but buy the whole winery. And even though we talk about potential tariffs, the strong dollar, the strong but dollar also is what's made these things so cheap. So I think that creates great opportunities, and then also managing behavioral biases. And as I said, I'm not a political analyst, and we've got to take our political opinions and set it aside and manage through kind of this market and quite frankly, the political unrest that we're going through right now in Washington. And really, if we can use this as the opportunity to rebalance the portfolios, to make sure we're in the correct place, to manage your accounts, to meet your long-term financial goals and objectives. We did, if you'd like, we have the question and answer tab, the Q&A. If you'd like to, feel free to reach out to ask any of us questions. A couple of you did send some questions beforehand, and I'll address those while you all put together your questions. Someone asked, are we monitoring Schwab's performance? Schwab is the custodian that probably manages 60 to 70% of the client's assets. Concerned in light of the fact that they moved their headquarters from California to Texas, and they, about 2 years ago, bought TD Ameritrade or TD Ameritrade. Quite frankly, what we're seeing in the marketplace is there's quite a few companies that have actually moved their headquarters. Chevron has moved their headquarters from California to Texas. Schwab is another company. So we are seeing this kind of migration from California to Texas. I think if anything, from corporate America standpoint, California is very expensive. As far as their tax structure, very expensive for employees to live there. There's a lot more land available in Texas. Texas is, I would say, a more friendly state than California. So that does not concern us. And also, worst case scenario, Schwab, all assets held at Schwab are kind of covered under SIPC insurance. On top of that, I know that Schwab has additional insurance up to about $700 million per account. So that right now for the clients of Kendall Capital, that is not a problem, to be frank with you. Someone asked, do any of our accounts have exposure to the natural disasters that happened most recently in North Carolina and also in California? We have no, quite frankly, direct exposure. I think that probably the biggest companies being hurt are the property and casualty insurance companies. The investment research firms that we use to purchase individual securities, we have not bought any of the property and casualty insurance companies. We have bought some of the insurance companies that sell annuities, even though we're not big fans of annuity companies, but the annuity companies have done quite well. Someone asked in reference, do we have any concerns or strategic with the politics? I think we've addressed those issues in the marketplace. It is a concern for us. It's a concern for your money, and this is basically how we're managing through those things. Another question from a Maryland resident wants to know about the new Maryland taxes the governor's proposing as far as income taxes. He has proposed higher income taxes. He said basically for the top third of the earners in the state of Maryland. I point out the good or bad of Maryland. Maryland's income tax is slightly higher than states like Virginia, but Virginia has much higher property taxes. We've seen people, move from Maryland to either Texas or to Florida that has no income taxes, but then will be shocked that their property taxes will be 2 and 3 times as high. Their insurance rates are dramatically higher for the homes and cars that they drive and operate. I'd be happy to talk about any of this with you individually, but as I always say, when managing personal wealth, you don't want the tax tail to wag the dog. I think keep it all in perspective. Kind of worst case scenario, we've seen people pack up and move to, hoping to save, 10 or 15,000 on taxes, but spend, $120,000, moving, and the break even is, almost 10 years out. And then someone else asked about our 2024 performance of our portfolios. I know for the clients on the call, everyone's received their statement. And basically how your accounts did over the last 24 months. For the individuals who joined who are not Kendall Capital clients, we'd be happy to share with you, on a one-on-one basis at this time. I don't know, I don't see any other questions online. Does anyone, Brian or Jason or Zeman, do you all see any questions online?
No, Clark, I'm not seeing any right
Nope.
now.
Well, that's good.
Yeah, I guess.
You don't even see my question?
Oh,
We do
yeah,
see
no,
yours.
we saw your question.
Good,
I-
just
I
testing
think
the
I-
system here.
I think there was a question about Bitcoin. If I'll just read it. Bitcoin is a concern. Are we staying out of Bitcoin? And larger concern that moves to provide the same guarantees as banks.
Bitcoin, I mean, sorry, what was the question again?
I think if I'm understanding correctly, it's asking, are we staying out of Bitcoin? I'm not sure if it's a concern positively or negatively. The question that was asked, I'm a little less certain on, I don't know if you guys can see this, the second part of it, but I think maybe just generally what our thoughts are on Bitcoin, if we're staying out, investing in it, that sort of thing. Maybe a question for Zeman or Clark rather.
Well, I'll start from my perspective. We believe in the basic philosophy that all investments boil down to a return of cash flow and the predictability of the cash flow. For example, if we buy a 90-day treasury bill, we know within 90 days we'll be paid back our principal and we'll be paid a small amount of interest. It's very predictable along those lines. At the far extreme, if you buy raw land in Texas, you don't know when you're going to be able to sell it. You don't know how much you're going to be able to sell it for. It becomes very unpredictable. I think all investments kind of boil down between those two things. Bitcoin, I have a hard time seeing the underlying economic value. There's no earnings made from it. There's no interest earned from it. So we have not gotten on the bandwagon as far as owning Bitcoin at all. And so we have stayed away from it just because we don't see the economic value of owning it. I'd rather own 1,000 acres of farmland, either to raise cattle, to make hamburgers for McDonald's, or to make wheat and barley, basically, so it can be sold to Quaker Oats to make cereal. I just don't see the economic value. So we've stayed away from it. And the people who have made money from Bitcoin, I understand their argument. The safety of the currency, the fact they're not printing any more, Bitcoin, but we have not participated in it for that reason.
Yeah, just to add to Clark's point, right? To qualify it as a currency, you need a storage of value and you need a facilitated transactions. So in terms of facilitating transactions, Bitcoin requires a large amount of blockchain calculation called a hash function. The function on underlying hash function is called hash 265. They hash twice, and then they try to brute force a serial number within the Bitcoin system called system difficulty to force a blockchain to be attached to existing blockchain. So the more transactions you have, the longer the chain gets, the slower the transaction, the calculation processes. And also another argument for Bitcoin will be decentralization. But however, to facilitate the transactions, to make it actually viable, you have to concentrate computing power. That's why there is a large purchase of NVIDIA chips previously just to mine Bitcoin. It leads to centralization rather than decentralization. And the third is to adopt it as a currency or fiat currency backed up by the federal government. It's very unlikely. Think about it for Fed to increase money supply through open market operations to control short-end interest rates. Bitcoin can be controlled. It has limited supply. Government can control it. Government can monitor it. Transactions anonymous, but which is not essentially because it's controlled by a few large mining power companies. If they have the computing power long enough, they can change the entire chain history. That's why it's Bitcoin Cash and Bitcoin Cash and Bitcoin. Basically, it's called a fork. So anyway, we can go to tacticality of it, but just based on arguments that it's basically a trading instruments where if you understand it, the supply to demand, you want to get in, get out very quickly, make a quick buck. I think it's a right way to do it, but holding as an asset class for long-term asset allocation, I agree with Clark, it's not viable.
And then there's another question, I think, just now about our 6 portfolios. I think we went over them without kind of giving you like a general slide on it, but we have 2 bottom-up focused equity portfolios. So we buy individual stocks. I mentioned the GARP and the income and growth portfolio. Just briefly, we're using research services to act as portfolio managers. We're screening through stocks on a monthly basis. The GARP is growth at a reasonable price, so we're more growth focused. We're looking to create a diversified basket of securities that are more revenue growing companies. Still focused on valuation, as you saw in the presentation. And then the income and growth, we're focused more on current income, so dividend yield. So we consider it a more conservative strategy versus the GARP, but they are both individual stock portfolios. They're especially efficiently located in taxable accounts where we can manage those gains and losses by selling individual securities and tax loss harvesting where appropriate. And then the other 4 strategies Zevin went into some detail on are the mutual fund or ETF portfolio strategies. Those are more top 10 allocations. I don't know if anyone like Clark or Zevin wants to discuss those, but we essentially blend them to come up with your overall asset allocation. So while we have those 6 strategies, they're essentially uniquely blended into each client's overall portfolio.
Yeah, I think you summarized it perfectly. For fund strategies, I think we also mentioned during presentation, it will be more like top-down approach and as a good complementary to the individual equity strategies, where individual equity strategies returns more be driven through idiosyncratic risks, where the ETF or mutual fund strategies more driven through top-down asset allocation decisions through large, mid, small cap, and also international versus U.S. domestic markets. We also have the inflation protection strategy, where it serves as a cash alternative to park cash for short to midterm cash needs. So I think that's it. Clark, you want to add something?
No, I think you guys did a great job along those lines. As I said, I think we have a lot of the concerns that you do as clients. And I'm proud to say when I look back at our history of how we've had value for our clients,